As investors evolve from savers to retirement spenders, the search for income has seen many investors seeking income from dividends. But as you'll see, it isn't always easy to stay the course. At Miller Howard Investments, we've specialized in high dividend yield stocks for more than 30 years, and we think now may be the time for investors to renew interest in the high dividend investment universe. Let's look at market returns based on dividend deciles, meaning that we've sliced the market of dividend-paying stocks into 10 segments, sorted by highest to lowest yield. We'll also look at non-dividend-paying stocks as a group. This chart shows the universe of all U.S. exchange-traded companies with a market cap over $1 billion. We use deciles 7 through 10 to represent the high-yield stock universe. The most recent average indicated yield for each dividend decile is shown on this chart. Dividend investors have experienced a difficult 5 years. The top 4 deciles, or the top 40% of dividend payers, have recently underperformed lower-yielding stocks as of December 31, 2018. This is in contrast to long-term history, which has been one of outperformance. Interestingly, non-dividend payers were the only group of stocks to outperform the S&P 500 index during this 5-year period. You see similar results over the past 10 years. The 10-year results are skewed by the last 5 years, we think. Non-dividend payers remain the only group of stocks to outperform the S&P 500, with higher dividend payers generally underperforming. But is this direction or distraction? Should investors conclude that high-yielding equities will persistently underperform broad market indices? Not at all. That conclusion would represent recency bias, when investors give outsized importance to recent events, obscuring long-term trends and cycles. To illustrate, let's take a look at these same charts ending in 2012. At that point, your conclusions drawn from history would have been just the opposite. Again, let's start with the 5-year chart ending on December 31, 2012. Note that 3 of the 4 highest-yielding deciles outperformed the S&P 500. The lowest-yielding decile was the worst-performing group of stocks. This is a 10-year performance chart ending on December 31, 2012. Here you can see that all 4 of the highest dividend deciles have outperformed the S&P 500. Viewing the same information in a bar chart is another way to see these 2 time periods side by side. Market observers will continually debate whether or not this time is different, but we would suggest that a key component of an investment plan should factor in full market cycles. Often, the best strategy is to remain patient and stay true to your initial investment thesis. In conclusion, we believe it's important to stay on course and ignore short-term distractions if you seek long-term returns and income from dividend stocks.